There we go. Hello everyone, welcome back. Today we're going to be doing episode 2 of our income only challenge for Wall Street for Speculator. So basically, I feel like it would be a good idea to cover a bit more things. So last episode I did a bit of a slideshow where we covered a bunch of things about bonds and how they work, and a little bit about stock analysis. But today I'm going to be going a little bit more in depth about how to analyze stocks and my personal opinion about the market. So I worked on this slideshow just yesterday, and I think I did a good job with it. So we got it right here. We do record slideshow from beginning. I don't want that thing. Cool. So today we're going to be doing the Income Portfolio Series, episode 2, and it's from Roin Software, and you just search up like Speculator or usually I do Wall Street Raider. So like that's how you get the game specifically. So like for example, you just go over here and just do Roin Soft Wall Street Raider, and then it's this website over here. So it looks, the website does look a little bit older, but it is a very, very interesting game. You can this is Wall Street Raider, but you can get the other game, which is Speculator, and it's about $10 USD, I believe. Oh, $20, and if you want to update, it's about $10. But like there is a lot of content in this game, like I covered in the last episode. So if you guys want to watch the other episode, that'd be pretty great. But today we're gonna be covering basically my whole opinion about the market and basically what I believe in when it comes to the efficient market hypothesis. So I'll go into that a little bit. Okay, so a quick little disclaimer. Like this video should be only taken as basically, it should be taken as financial advice because everyone's situation is completely different. So it makes sense to go ahead and deal with an advisor or have a DIY approach. Like personally, I personally taught myself this at 16, and I'm currently like 21. So I've been doing this for about 5 years with my own money. I started off with like $2,000. I bought like a GIC, which is guaranteed investment certificate. And I also started off with like an ETF. So I feel like that was a decent start for me personally, but what I cover in this video might be different for your scenario. So I would advise you either do deal with an advisor or do it yourself, but make sure you cover yourself when you do it yourself because you could lose money. And right now I am losing lots of money on the stocks right now. So it's not like a guaranteed way to make money with my strategies I cover. If you have any concerns, please visit a licensed professional. I'm not recommending anything with this video. And the game that we're going to be playing is called Speculator by Roinsoft. And it's by Michael B. Jenkins. And he is the creator of the game. And I really enjoy his expertise about this game. So then the agenda for today will be the efficient market hypothesis and exchange traded funds. So these two both kind of work really well together in my personal opinion. And then a little bit about market anomalies, and then a sample company. With the market anomalies, I'm also going to cover like my personal opinion on where I land on the efficient market hypothesis. But like that stuff is a little bit complex to learn about, but I think it definitely does help with your investing life, is knowing where exactly you land personally in your own personal opinion about where you land on EMH. So some quick definitions. A mutual fund is a professionally managed pool of money, holds cash for redemptions. So another cool thing I was going to add is that like one thing that mutual funds often have as a disadvantage is this thing called cash drag. So like if you're going to be investing in like mutual funds, for example, a very, very common thing is called cash drag, which basically it's very, very common for mutual funds because in order for people to get redemptions for their mutual fund, they basically have to keep a bit of cash just to make sure people get their money whenever they want to withdraw. So cash drag can potentially affect your performance because you have so much cash. And if I sound a little bit nasally or whatever, it's because I caught a cold. Last week I got to spend a bit of time with my cousins, and he had a cold, sadly. And I got tested for COVID. I did a rapid test, but got nothing. So I was going to do that later today. But I'm still feeling a little bit off, but I have some hauls, and I'm good. So for a mutual fund, it's just a professionally managed pool of money. So This is active management, and I'll go into that a bit more later. And the MER ranges from 1 to 3%, and I got that from like Daedrogen's website. You can just search up like the average MER for a mutual fund, but the MER is basically the management expense ratio. So it's like the amount of percent that they take away from your performance every year, just to make sure everyone gets paid. And so with active management, you're hiring professionals, so they have to put a bunch of work in. They have like a team, and so it's much more expensive. That's why the MER is usually higher. And then exchange trade funds, they track a specific index and is sold on the stock exchange. And so like I found that pretty interesting. It's often passively managed, so it's below 1 MER. You can buy active management, you can buy actively managed ETFs, and you can buy like different strategy ETFs. Like one that I personally have a bit of my money in is ZWC, just because I find this one pretty interesting. So like this strategy, I like this strategy personally. It's a covered call ETF. So that I have a bit of my money in this. The only problem is if you look over the last 4 years, it's been flat mostly. So that's because that's because their strategy is a bit different. But this is considered an ETF because if you look at like the MER is very low, and it also says ETF on it. So like this is an example of like an ETF. And we can like look into like the fact sheet and like look into the holdings. For example, we have the MER is like 0.72. So in order to calculate like the total amount you have to pay every year. So we're gonna do 0.72, and we're gonna divide that by 100 to get the actual percent. So it'll be that times like maybe let's just say you put $1,000 into ZWC. You're gonna be paying about $7.20 every year, just for them to manage this fund for you. But the dividend is actually much higher than the MER, so I really like this. This is a really good ETF in my personal opinion for income. But the one thing that's bad about it is they do covered calls. So the strategy is, I'm pretty sure I researched in another document, they do a 50% out of the money call. So a 50% out of the money call being they sell a call. Let's just say the current share price is 50. So then they'll sell a call at 75, get a little bit of premium for that. And if the stock price falls, it actually makes it better for the ETF because they get a little bit of that premium for selling the call. So it's a nice little strategy for flat to downward markets, but it's not immune. Like as you can see, during 2020, it fell a lot. So I just find this as a very, very interesting ETF. Like if you want a monthly income source, you could directly buy this. But I would look into it and do your own due diligence. Like, are you comfortable with having 36% of the money in ETF, in like that? Another one I like is ZLB. So like this is like a low volatility ETF. So it has like a lot of utilities and everything. So yeah. So like if we look over here on the very bottom, in my opinion, this is much more diversified fund than this. This one has like a lot in financials. And the interesting thing about financials is that they're typically a cyclical industry. So whenever interest rates generally go up, they tend to do better. And if you want an alternative to ZWC, in my opinion, ZDV. So if you look at ZDV, it's quite similar. The percentages are a little bit off, but like it's quite similar. 36%. This one's much more better if you have like a longer term time horizon, because you can actually get capital gains with this. Well, as ZWC, they do covered calls. So like that's just something I found very, very interesting. A little bit of a side rant, sorry about that. But like here we got exchange trade fund, mutual fund. So another example of a mutual fund will be, so like for example, here's another one. I do not have any investments with this one, but I do own ZDV and I own ZWC. I've been tempted on buying the low volatility one, ZLB. But like for example, like here is an example of a mutual fund. So like you can see the MER is 1.87. That's actually kind of reasonable, but after like 3%, I think it's expensive. If you want, another interesting thing are segregated funds. So segregated funds basically offer, uh, segregated funds, they offer like a bit of a guarantee, but they tend to have higher MERs than mutual funds. So if you want to protect your capital, sometimes it's better to go for a segregated fund because after 5 years, you get a 75% to 100% guarantee if you go into segregated funds. So that's a nice little side rant. But like here's an example of a mutual fund. And then we can look into like the fund facts, for example, and see what they hold. So like this is a pretty interesting fund to own, in my opinion. I've been tempted on owning it because like it's been a pretty great fund because like they've been returned 21%. Worst year was negative 17%. It also gives a risk category, which is interesting too. So ETFs, I feel like, are a really great option if you have like a low amount to invest, and they're also good if like you just don't really give too much a dang about the market. And you don't feel like going in and out of the market. You don't feel like doing your own individual stock research. You just want to make sure you get a brief understanding of all the holdings. Like for example, the top 10 holdings right here are RBC. So I'd look into RBC a little bit, understand the story of the company, and maybe learn a bit more about the fundamentals, like the price to earnings ratio, etc. And then just say, am I comfortable with holding that much? And I feel like it's a very interesting ETF. I don't mutual fund, my bad. So there's some examples of ETFs and mutual funds in real life. Another example is fundamental analysis. So this is what I tend to do whenever I play Wall Street Raider. I never really go into much detail, but this is like how Warren Buffett looks for stocks. So it's finding stocks with a fair value per share from the actual or expected profitability of the issuer. So the actual or existing profitability is the most important criticism, or like the most important criteria for researching your stocks, because like for example, we got companies like Uber, and we got companies that just aren't earning any income, or not earning any earnings, like they're not making any profit. They're getting destroyed right now because their profits are way out in the future. So those are considered growth companies. But every now and again, growth companies can be a good value. Like personally right now, if we, what is it? I want to look at. Like for example, another fund that I hold that is an ETF is VFV. If you look at this year to date, I believe a 20% downward trend is a correction. No, 10% is a correction. 20% is considered bear market. So if you look at this year to date, I've been buying this since the beginning of the year, and I've just been buying on the dip every now and again. And I've been doing this strategy called dollar cost averaging. So every quarter or every month, I contribute X amount of dollars of my cash towards buying the dip. And thankfully, the market has been on sale a lot now. So we have about 3% more until the S&P 500, which is the top 500 companies in America, until it goes into bear market territory. And in my opinion, I feel like it's a good deal whenever it hits bear market territory, but it could go down more. So that's why I am being a little bit cautious with this current environment that we're going through. We're going through high inflation and everything else. Another one that is definitely in bear market territory is XQQ, which I also own. And if you look at this year to date, it's down 27%. So if you want something more aggressive, NASDAQ 100 is definitely the better pick. But like VFV, I'm doing this strategy called Satellite and Core. I can't type today. So like here's an example of like real life. So Satellite and Core, your core, and there's something called satellites. So for example, these ETFs are considered my core. So I'm working on my core a lot this year, where I've been buying a lot of VFV and a lot of ZDV and a little bit of XQQ. I'm tempted on buying XQQ into my TFSA just because my TFSA is mainly meant for income, but I want to prioritize more growth because it's on sale deep right now, and we could go into a recession and this thing could crash anymore. But right now I feel like people are being a bit too pessimistic, and in order to determine the pessimism, I look at this thing called the VIX, and I covered this in the last video, but if you look at it year to date, or if you look over the last 5 years, it usually ranges around 10 to 20, but every time it hits like 30 and above, usually is a great time to get into the market. Like over here in 2020, the entire world was ending. This is basically the short-term volatility for the S&P 500. So volatility being big swings upward or downward. So right now there's been a lot of volatility in the market because of raising interest rates, the war in Ukraine, everything else that we're experiencing right now. But like I've been tempted to buy more XQQ, and if you want to look into it, it's a BlackRock fund. And in my opinion, I always use the fact sheet just because it summarizes what the fund does. So this is the top 100 companies on the NASDAQ. And the NASDAQ is basically only tech, mostly tech. Like it's got about 50% tech, a bunch in communication, a bunch in consumer discretionary, and then not much in anything else. But like it's got a lot in Apple, it's got a lot in Microsoft. But like the thing is, if these two stocks fall, it's likely that the ETF will fall. And then VFV, so like this is considered like a growth ETF. But like if you look at like, for example, VFV, for example, you look at like the fact sheet, this is considered a value and growth blend. It's considered a large cap blend. Okay. VFV beta. Yeah, so basically the VFV, it has a lot of money in like Apple, Microsoft, but like there is a lot of value companies in here, like oil companies and everything, that are currently trading for very cheap. So it's got a mix of growth and value, which I love about it. And then ZDV is mainly dividends. So that's why I've been reprioritizing my personal portfolio towards those two holdings, just because in my personal opinion, I feel like those are really good core holdings. And then I can have individual stocks being my satellite. The satellites are like your individual stock picks that you have high convictions over and you can do really well with. So when it comes to this game, I've been trying to aim my portfolio in this game, in Wall Street Raider, no, Speculator, towards those two, like towards satellite and core and etc. So technical analysis, I tend to never really use this besides support, resistance, and RSI. RSI being relative strength index. So if the RSI I think is above 60, it tends to be overbought. And if I think it's below 30, it's oversold. So basically, if a stock is oversold, it may be a good buy. Like that's a good way to determine if it's cheap. And if it's at support, it's a cheap price too. Well, its resistance is when you want to trim or you want to sell. And then now we go into like the efficient market hypothesis. So like this is when things get a little bit complicated, but I'll try to explain it the best I can. So the efficient market hypothesis basically says that the prices of shares reflect all information, and being the market is basically impossible. So basically, if you're a strong believer in efficient market hypothesis, you believe that all public and non-public information is accounted for in the stock price, so nobody really has an edge over the market. So an example of that will be exchange trade funds. So you can search this up on Investopedia. I got this from Investopedia. And semi-strong is basically, you cannot use technical analysis or fundamental to beat the market. But people that have like an insider edge, they have an advantage. So executives and insiders have an advantage because they can see non-public information before anyone else. But there are restrictions against that, which is nice. And there's weak, where basically you don't use technical analysis and you only use fundamental and determine the company is undervalued or overvalued. So like mutual funds or a value fund would be a good example. And then random walk theory basically says that a stock's past price movements are irrelevant because that had to do with the data. So I don't really believe, I do kind of believe that stock prices are kind of random because every now and again you could pick a perfect company that's fundamentally solid, but yet the market isn't fully efficient, like it will crash. And sometimes your decisions are wrong. Like we can do, like volatility is something that we cannot control, but we can control our losses by picking great companies. So if we pick a great company, volatility really doesn't matter unless the company's fundamentals start to fall, in my personal opinion. Rational expectations theory states that humans are irrational and they'll update the information based on the information they receive. So like for example, if a company reports like a quarterly earnings report, like the stock price will move almost immediately. But there are some people that I personally believe that aren't completely irrational. Like, I'm not completely irrational. Like, I'm not going to read through a few 100-page annual report unless I have, like, a lot of money in that stock. That's just my personal opinion about the rational expectations. So now we're going to go into a bit of ETFs, where these are exchange trade funds. So these are sold in the open market. And here's an example of a Bitcoin trust. So the Bitcoin trust, you can go into, like, the research on the fund, and then you can see the advisory fee is 0.20% of assets. So it's about $20 a year for every $10,000 invested. And for the energy fund, it's about $50 a year. And then you can look at, like, the NAV. The NAV is similar to the book value. Basically, it's the net asset value per share, and then the current price. So, like, you can see currently, these two stocks are a little bit overvalued because the current price is above the NAV. So you're not buying a stock for less than its book value. And then you can see the dividend. And then the World Energy Fund is more diversified across industries. So, like, if you can read this, it says, like, Oxy's at 8%, etc. And then the Bitcoin Trust is known as, like, a thematic ETF, where they have a specific theme. So basically invest 90% of its money in Bitcoin and 10% cash. So personally, I'm not much of a fan of thematic ETFs, and I do have a video about that I feel like sharing later. So here's the market anomalies. There are some market anomalies that you can do. There's a very, very interesting Investopedia article. Am I still alive? Yeah. Wait, nobody's on that chin though. Okay. So, like, this is an article that I found very interesting about market anomalies. So it talks about, like, neglected stocks, reversals. So, like, I think reversals, a good example of that is, like, Cathie Wood. So if you're going to go up there and buy, like, a mutual fund and it's the top performing fund, you gotta be skeptical. You gotta be like, is this fund going to continue to outperform every year? If the management is very, very exceptional, then that's great. Like, for example, an example of that would be, like, Peter Lynch. This guy run the Medellin Fund for from 1977 to 1990, averaging an annual return of about 30%, 20.20. So, like, this is an example of a great fund manager, because, like, he actually will, but, like, for example, you bought Cathie Wood's fund in 2022, you lost a lot of money. Like, for example, the ARK fund, if you look at this year to date, it's down about 56%. But you look at it over the 5 years, like, if you bought this thing in 2020, you would make, like, 257%. But right now, just because it was a top fund doesn't mean it's going to continue to become a top fund every year. So, like, it's lost a lot of value lately. So I found that very, very interesting. So, like, for example, some things I included was, like, the lower PE stocks tend to outperform higher PE stocks. So a bit of a rationale or explanation of that would be, like, the value premium and pessimism about future earnings. So if a company has a high price to earnings ratio, it means investors are willing to pay for the company's growth in the future. So lower PE stocks tend to outperform because they're hated by investors. Neglected firms are low analyst coverage, corporate spin-offs, or disliked by investors. So an example of that was when I was younger, I invested a few years ago, I think 2019 or so, I invested in something called SNC-Lavalin. And they were a very popular stock during then because the Trudeau government was taking them. Basically, the ex-CEO bribed people for contracts. And I just saw it as a very, very good value play because the 407 was being sold for $10 billion, and I think the stock at the time was trading for less than $10 billion. So I was like, the physical assets that this company has is more than the current price. So I was like, they're gonna sell this thing to a pension fund, and it'll be a great idea because it's currently disliked. So that's an example of, like, value investing with neglected stocks. Another thing will be also probably low volume stocks, like stocks that aren't really traded much or not a lot of people track. So where do I stand on the efficient market hypothesis? I'm weak and semi-strong. So, like, if we look over here, I'm weak and semi-strong. So in my personal opinion, I believe that technical analysis and fundamental analysis can sometimes fail you. So it's nice to have ETFs and some active management because you believe that the market is inefficient, but at the same time it's efficient. And also I like to use weak EMH because, like I said before, with the rational expectations, people are irrational with like Dogecoin, the whole SNL thing where Elon Musk just talked about Dogecoin and he's like, it's a grift, and then the stock just went up a ton. Like, that's irrational behavior in my opinion. So like, I think humans are not fully irrational. Humans are not fully rational based on what they see, because we have biases and everything else. So I believe that humans aren't fully rational, making efficiencies. There's too much fear or greed. Investors perceive information differently, and it's hard to keep up with all the relevant facts. In the long term, the market is efficient, because if it wasn't efficient, then you would lose money over the long term. And a very interesting quote from Benjamin Graham. I thought it was from Warren Buffett, but it talks about, in the short run, it's a voting machine. So technical analysis is basically like a voting machine. People are like, I'm voting on this stock based on its past movements, or I'm betting on this stock based on this. But in the long term, it's a weighing machine. Depends on how much you put into it. So I found that very, very interesting quote. So here is a sample company. I'm sorry for the large amount of words on this slide, but we have the borrowing rate of a sample company. So the sample company is Office Equipment. It's a Live Spa, I think that's what they pronounce it. So the current borrowing rate is 5.5%. This is known as the WACC, the weighted average cost of capital. And the prime rate is 5. They're currently A. I think they're A or no, they're double A. That's my bad. So that makes sense on why it would be 5.5. I think so. And the long bond rate and the short bond rate. So like, I just have those to like explain on like why I would issue bonds in the game. So that's a Wall Street rate or thing. So the bank loan is a variable rate loan at $254 million a year, or $63 million per quarter. The thing about variable debt, I tend to be very, very skeptical about it, and it's a cheaper form of debt, but the problem is whenever rates go up, your payment or your amortization goes up. Amortization being the length of the payment, so it'll take you longer to pay off the loan if interest rates go up. And then the return on capital is 20.40. This is based on the industry and the economic cycle. So if the industry slows down, basically the return on capital would slow down too. But like, if you see the ROIC is bigger than the WACC. So the ROIC is basically the return, the pre-tax return on capital assets. So if you see that, it's 14.90. So this company is creating a ton of shareholder value. So in order to boost shareholder value, in my personal opinion, for this company, if you're playing Wall Street Raider and you can do an activist position where you buy out the entire company, or you buy at least 51%, making you the majority shareholder, you can issue a bond, or you can become the CEO if maybe you own less than 50, but that might not happen. You have to own at least 51, in my opinion. So like, if you buy into this company, you can issue a bond at maybe 6.5 to 7.5% coupon, which is 2% higher than the borrowing rate. But in the game, I tend to see that interest rates go above like 8% often in the game. So a very, very common strategy that I go into later is Rake and M's bond cancellation strategy. So whenever your bond price hits about $70 or $80 is usually when I consider buying back or calling my bonds. Most of the time I buy back though, because it's a better strat. So like, you'll make about a 30% pre-tax return. So it's a very, very good idea. So below 8% is when you consider buying back the bonds. So greater than 8% is usually when I consider. And another interesting strategy that I discovered recently is, in order to if you're in variable rate debt, which is cheaper, you can actually hedge out that debt by doing an interest rate swap. So what you do is you do a short position, bet that rates are going to go up. So right now at 1.98% on the interest rates, that's fairly low, because the average in the game is usually around 3 to 4. So if it's above 3 to 4 is usually when I consider buying bonds, but around 8 is usually when it's a great idea to do bonds. But I usually issue bonds whenever they go below 3 or 4 in the game. So in order to hedge out like your in order to hedge out your bond or hedge out your variable rate debt, I often do interest rate swaps, and you just do the nominal value at 8,480. And I'm doing 30% debt to equity ratio with this. So if you look at the company, the equity is 28 billion, and you times that by 30%, you get 8.4 billion. So that extra about 4 billion that you're gonna have after repaying the loan, because you're gonna basically get that loan, and you're gonna refinance it into a bond, which will be a much cheaper form of debt if rates rise. It'll be a very good strat, because then you have tons of money to grow your company. Because a very, very important thing that not a lot of people pay attention to, in my opinion, is the capex. So the capex being the capital expenditures, like how much each quarter are they investing in property, plant, and equipment, or a building or a lease to make sure they grow their revenue over time. But it's an investment every month. So I also have a video of that later on, which I found is interesting. And then if you're playing Speculator, you can purchase the common shares as the ROIC, return on invested capital, is bigger than the WACC, or their borrowing rate. And the free cash flow is $1 billion. They have a very low debt to equity, and they have liquidity to repay their loans. So they have enough to cover about half of their bank loan. So if rates do rise, they're not in a lot of trouble. So then we got episode 2 summary. So determine your views about the efficient market hypothesis. So which one do you stick with? Do you think that you're weak, or do you think it's strong? Sometimes just going for the strong method is the better option, but sometimes the weak option can do better. So I am in a bit of the middle where I want a bit of both in my personal opinion. And invest in ETFs or mutual funds. So you want to compare the MER. So typically MERs are high for mutual funds, which help take away the performance. But if the company's quartile ranking is a 1 or 2, you can get that from Morningstar. So if the company historically outperforms, like the Magellan Fund from Peter Lynch, if you bought that fund and you're paying like a 3% MER and you're getting 29% annually, I am not going to complain about that, to be honest. Well, as if you make like a 10 or 15% return off ETFs and you're paying like a 1% MER, you're doing all right, but you're not doing as well as the active management. Oh, I have no data. Okay, excellent collection. So market anomalies. So small firms tend to perform, etc. So it goes into like that. Let's skip. Yeah, I already got that up. We're good. And then the sample company summary. The return on capital projects has to be bigger than the interest rate on debt. This creates value for shareholders. Invest in companies with less than 50% debt to equity. When short bond rates are below 3 to 4 or below that, you want to issue bonds instead of having variable debt. And so here's some other topics that I found very, very interesting over the last few days. So a very, very cool video that I really enjoy right over here to the left is Everything You Need to Know About Finance from Bill Ackman. The video is called Big Think. And then stablecoins are unstable. Thematic ETFs are a terrible investment. And then the bond cancellation strategy by Clipnop, aka Rick and M. So I found that a very, very interesting strategy. So I feel like it would be good to probably cover a bit of that. Like if you want, I'll probably just play through a bit of it. Like he covers everything. He goes over why you want to own debt and why you want to own equity, the statements. So you got cash and fixed assets. You got cups sold. So you got your income statement as an example right over here. You got the lender. So Bill Ackman is one of my favorite hedge fund managers because he runs a very, very cool fund called Pershing Square Capital. And he's just a cool mentor to learn from. So this video I feel like is a very good video if you're new to finance. And the stuff in the middle is more intermediate to advanced stuff because Ben Felix over here, he covers a lot of stuff in very, very complex language that I have trouble understanding sometimes, as well as Patrick Boyle. But I found this very, very interesting because $40 billion was destroyed by owning cryptocurrency. So that is why I tend to be a little bit skeptical about cryptocurrencies, just because like there's been a lot of debacle lately about the whole like stable coins. Like if something gives you 20% return, in my opinion, that's not a stable investment. And if you look at like the price of Terra, for example, Terra. So like I am not gonna, but like in my personal opinion, this is not a stable coin. If you look at this year to date, this thing was like $115, $51, and then it just all of a sudden crashed, and you lost a lot of your money by investing money in this stable coin. But you did get a good interest rate if you stake it, which I found is a very, very interesting little topic. And then the bond cancellation strategy is good for when you play Wall Street Raider. And you can make like $100 billion in the first year. That's what he said. So like you generally
Hello
want to start
everyone, and
hard.
welcome to a Wall.
So like there's your criteria. So like the initial prime rate in Wall Street Raider 9. So like the higher the difficulty, like the higher the interest rates generally are. So you can actually make that a better strategy because you can call back those bonds when you take over the company. So it's a very cool strategy that I discovered from him. And I've implemented that strategy and modified it to serve my personal needs because I found that very interesting. And that's it for the slideshow. So I found that very, very interesting. And now we're gonna go ahead and play some Wall Street Raider. So I'm just gonna go ahead and get rid of my display. Get rid of my display real quick. I'm gonna play some Speculator today. I just don't want to make sure. I'm just making sure my ID doesn't come up. Sometimes it comes up, and I don't want you guys having to. There we go. So we got our game. Where's our? Okay, so this is where we were last time, and I just want to write down like a quick timestamp. So about 36 minutes. That way I can remind myself whenever we start the gameplay. Okay, so let's go ahead and get this all set up. So we're playing Speculator. So we do streaming quotes and we do commodity prices. That way we can tell whether or not our bonds or stock are doing well. I want to move that a bit more to the right. Sorry about that. There we go. So last time when we left off, we did break our asset allocation target by like quite a bit. Where should I put my calculator? Let's put it over here for now. Like as you can see right here, we have a little bit in cash just for taxes, I believe. But we got $60,000, which is in Bitcoin, and it's in equities. So we do 60,671 multiplied by 119,724. Oh, okay, my bad. 60,671 divided by. So right now we have about 50% in equity. So we are very, very overweight on equity. No, we're actually underweight on equity by about 10%, because we have Bitcoin in there and we have equities in there, but we are overweight on bonds. That's because we're doing dynamic asset allocation. I'm shifting my asset allocation towards more of the better performing asset class that I see in the next few years. So right now we have 46% in fixed income, so we're 6% above our target, and we have a little bit of cash. So right now interest rates are very, very high. So right now it makes sense to put our cash flow, which after tax is about 2,300. So that 2,300 will be put into bonds. What kind of taxes do we owe? We owe a little bit of taxes, about 3K I would say in taxes. So I just found that very interesting because we're going to be buying like long duration bonds. So like you can see right here, the current year I believe is 2023. And we bought a 2025 bond, which I might sell. But this is a long duration because it's like 20 years out. This is over 20 years out. So if you want like less volatility in your bond prices, you want to buy shorter duration, aka shorter yield to maturity. So like these two are 20 plus years out. So you're making like a fixed income percent of like 10%, I believe. But the problem is you're locking that in for 10 years. So I'm a big fan of that. So right now we're going to go in and continue. I want to probably put it at 70 on the speed. That way you guys can comprehend. And how's our portfolio doing? We made a decent amount of money on Abjects. So last episode, this was our biotech company that we bought. So right now you can see that they don't have a lot of liquidity, but they do have great earnings growth. Like last year they made 18 cents a share. Now it's 45 cents a share. And it's the third quarter, so they're about to report their fourth quarter earnings. But the problem is their debt to equity is very high. And they're considered junk. So like this is considered a junk bond. So they do have a very high borrowing rate, which is about 2.25 above prime, and they're growing a lot. So if we look into the business, this company is actually not too much of a great investment, in my opinion, because if you look at the capex, it's $89 million a quarter. So you can see right here that they're about to lose $59 million in the quarter, and so like they're expected to have negative cash flow in the next few months. And they only have $285 million in a bank loan that they can take out. So this company does not have a lot of liquidity. The only thing really I would count on this for is capital gains. Like it's very speculative though. But they are about to make 40 cents a share. But I may end up selling that stock just because it is a very expensive company. And then all the other companies we bought, they're doing okay. We did trim out the Bitcoin or the Ethereum trust from last episode to take up some capital gains, so I was pretty happy with that. But right now we're mainly sticking to bonds because we want the income and the potential capital gain if interest rates do fall. Cool. Yeah, about $4,000. Let's play a different song. Yep. Okay, I think maybe 80. So I want to watch this junk company. Oh gosh, they are booming. Okay, how much are we paying for the company's earnings? That is my big question. So as you can see right now, they don't have a lot of liquidity. And the company is very expensive. It's 59 times earnings, a very bad debt to equity ratio, and they don't have a lot of liquidity, and they're growing. So if they had like a 0% growth rate, maybe they would be able to generate free cash flow. But in my opinion, I'm gonna go ahead and just trim out of it again. So we're gonna have a very small position in the stock. I could sell out of it entirely, but I want to make sure that we do not get burned by buying this junk company, because it's definitely going to fall if their earnings do not keep up with expectations, because they are 50 times earnings. 50 years for $1 of their, no, $50 for $1 of their profit, basically. So we're going to sell 816 shares, and we're going to keep a little bit of shares of this company, but I do not want to really buy much of it, because I just think it's very expensive, and there's better opportunities elsewhere. So we made about 16 grand in capital gains. So right now we have about, I would say about 7 grand in tax. So we're gonna put about 20 grand into the market, and we want to buy a long duration. So we are gonna go very overweight when it comes to our portfolio, but I will be able to trim it hopefully. So right now we can see that a junk bond is paying us 13.7. But like another company that's AA is paying us that much. A lot of liquidity, so they're able to roll into new debt, and they can do bond cancellation strategy. So right here, if you basically do 5,965 times 0.6168, so basically they can call back their debt, aka buy it back, because calling it I think is different, because if they call back their debt they have to pay a little bit above the prime, but if they buy back the debt on the open market they'll pay about 3.6k. So they'll be able to easily pay back their debt, and they do have decent earnings, but they are very expensive on the price to earnings ratio. But like this is a very good bond company, because currently the price earnings is very, very high. They have a very low debt to equity, not a bad dividend, bad ROE. So I don't really want to own the equity of this company unless it has a convertible bond. And you can also look into like the analyst. Supply demand is stable. So what industry is this in? It's in building materials. That's interesting. So that's a bit of a cyclical industry. Okay. So I'm going to go ahead and purchase a bunch of these bonds right here. So what we're going to do is we're just going to do 20,000. And then we go over here to buy the bonds. So we're going to buy 2046 long duration bonds. So when you do that, divided by the price. So it's 601.8. So we're going to buy about 32 of these bonds. And that will cost us about 19.8 grand. There we go. So now we are very, very, very overweight bonds. Like if we look at it right now, 45,777 divided by 130,178. So we got about 35% in equities and speculative. So we are very, very overweight on the bonds. So if we just 75,773. And then we divide it by 130. So we got about 58% in fixed income. So we're 18% above the target. So ideally, whenever rates do go down, I'm going to probably trim out my bonds and then go back to our asset allocation of 40, and 20. So cool. So we got our stock portfolio. We have a speculative junkie company. We got some Bitcoin. And we also got long duration bonds. So we got a lot right here. So we definitely want to watch this company, Masso Corporation, I believe, because we have 40 grand in them, which is like 40 grand or whatever. So about 30% of our net worth is in this one bond issuance, but over time I want to diversify more. So we're just going to chill with that stuff, and we're going to wait for interest rates to drop. So I'm going to go ahead and speed it up a little bit more to 90 maybe. So you can see in my chart, I started off pretty well. That's probably, that big bump is probably because of the Bitcoin. And then we've basically been dipping. So now if we look at our income is now adjusted cash flow. So we owe a bit of tax. Current balance. So after we pay our taxes, we should have about 5 grand of tax-free cash flow coming into us. Sorry about that. Okay. What is SBC doing? None of our stocks have done too well. Our bond portfolio is not doing too well right now, so we're just going to chill and hold for the long term. And it helps to also like keep up to date with a lot of these companies. Like I tend to have a very, very small portfolio in this game just because keeping up with all the details is very, very hard. Debt to equity is low, decent dividend, very, very expensive earnings, but they do have a great ROE, so it may be worth keeping this. They do not have much liquidity though, but they do have a lot of line of credit that they could potentially dish out of. They could do bond cancellation strategy again right here. That's a pretty good strat. That's for Wall Street Raider. I cannot take over this company. I think with Speculator, the maximum amount you can own of a company is like 10% of the outstanding shares. So that's not enough to really control the company. Like I could become an activist investor when it comes to Wall Street Raider because you can just control the entire company, while Speculator, you can't control the companies. So right here you can see that the interest rates are starting to slow down, which is good for us. And GDP took a bit of a nosedive. It was around 5%. And it dipped a little bit. So like, and oil prices are quite high. So the oil prices being high will affect GDP growth, and GDP growth affects the bond prices. So whenever GDP hits negative for 2 consecutive quarters, that being 6 months, that makes it a recession. And when a recession happens, generally interest rates do fall. So if we do see negative GDP growth and we go into a recession, interest rates will fall because interest rates are currently really high to basically slow down the economy. They're intentionally trying to slow down the economy to help prevent this thing called inflation that we've been experiencing a lot lately. So in real life, Bank of Canada has been doing 50 basis point hikes. So those are like 0.50%. So that's just because the economy is healthy right now. But if rates are too high, that could potentially hurt demand and cause a recession. But right now, I feel like the main problem with the market right now is supply. Like, supply chains are overwhelmed and everything else. So raising rates could help with some of that, but not a lot. Yep, objects. Let me just double check. This is our chart. This is the stock chart. You can see how volatile Abjects is. This is the junk biotech company, so they've been doing pretty well. I'm pretty sad that I trimmed them right here, but like, you can also you can also like look at technicals. Like right here, I would say would be about a support, and then this thing broke over the resistance line, right above there. And this thing kind of made like a bit of a support right there briefly, but then it broke out the. So this stock has been breaking the resistance line often. But the fundamentals of the company aren't too good. So just because you look at the technicals doesn't mean it could be anything. 31 times earnings, that's definitely a lot better than 50, what we saw earlier. Great ROE, but a lot of debt. So I'm gonna go ahead. What's the industry doing? Industry. I'm failing so hard on this right now. Industry, biotechnology. So right now, industry demand is 8%, and it's half of 15. So if we look at our company, what's it called? Abjects right here. So I'm definitely going to sell this company. If you own companies like CISO and CYTO, I would get the heck out of there because you're paying $15 for every dollar of book value. So the price to net worth is a very good gauge. And generally, whenever it's above 3, I consider selling or issuing equity. If you're playing Wall Street Rare, generally above 3, you want to issue equity. So we're going to go ahead and get out of biotechnology completely just because I have a bad taste in it right now. So we're going to take home about 13K in gains. And we're going to go ahead and buy more long duration bonds and break our rule of asset allocation, sadly. But I can do that. In real life, it probably makes more sense to stick to asset allocation because when our interest rate's going to go back to 10%, in my opinion, probably not in a while in real life at least. Because right now, interest rates are about 3% right now for bonds. And right now, the yield curve in the game is inverted, briefly. So like, an inverted yield curve is basically the short bond is higher than the long bond. So that shows that there could potentially be a recession in the near term. And if it's like a 2 or 3% above that, I would consider. Yeah, let's just. I'm tempted on keeping 23K in cash, but at the same time not. What's our expected tax? Expected tax. About $3,000. So let's put in our 20K into a long duration bond. We're gonna break our asset allocation by like a lot. But once interest rates do fall, we're gonna fall back to the target. So we're breaking the rules by like a lot. But we're gonna buy a Yahoo bond because it's A grade, which makes it nice and safe. Working capital, so they don't have a lot of liquidity, but the thing that they have liquidity for is a bank loan. They could take out a bank loan if worst comes to worst, but the problem is they don't have a lot of cash. And the thing is that's also interesting about this is you can like do something like in order to calculate like the weighted average cost of capital for this company, it's gonna be different. Like if they just have a bond, it would be about 6.75%. It would be 6.75%, but because the company also has a bank loan, so like it's equally weighted between the two. So right now the borrowing rate on variable debt is 12.50, and the borrowing rate on the bond is 6.75. So we just do 0.50 times 0.0675. So that's like 0.03375. And then we look into the variable debt, which is a bit more expensive at the moment. It's likely going to fall over the long term because interest rates are high right now. Where is it? It's 12.5. So we do 0.50 times 0.1250. No, I can just add that. And we just times 100 that. So the borrowing cost for Yahoo Inc. is 9.625%. So basically, it's about 50%, about 50% right here. Like if you, like 20K, like that's fairly close to 20K. I would say it's about 50%. So like the WACC right now is about 9.6 for the company. So right now their borrowing cost is quite high. And if we look into like the company, we go in here, economic industry, projections, and we go to Yahoo, you can see that they make 16.9. So we do 16.7 minus 9.6, I believe it was. 7.1% WACC. No, 7.1%. So they're generating a positive return to shareholders, and they're also investment grade. They have a very, very low price net worth. So in this game, I'm going to go ahead and buy some Yahoo. Hopefully the bond is convertible, but it doesn't say CONV, so it's probably not likely to be convertible. I wish it was, because this company is pretty great. I'm tempted on owning the equity, to be honest. The bond's also attractive too, though. That's the problem. So maybe we'll just do a bit of both. We'll do 10K of each. Just because I actually like the common shares of Yahoo. This actually seems like a great play in the long term. This is going to be mostly a capital gains stock, though. So like that's why I want to buy the bond, is for income. About 10K, cool. And then we're gonna buy up some more. We're gonna buy up some common shares of Yahoo. So we're gonna buy up 10K of Yahoo shares. If you want exposure to both, you do a convertible bond, but sadly they did not issue a convertible bond. So right now, if we look at the stock, it's a little bit above book value, but the company is set to grow 43 cents a share for the quarter. So if we do 43 cents for the first quarter, and then maybe it's to say that their profitability remains flat, that'll be 80. And then by third quarter, they're going to be able to beat last year's EPS. So basically, EPS is the most important factor when playing this game. You want to make sure the company is able to grow, but you also want to keep into consideration how much debt they have. Because if they have a lot of debt, that could potentially impact their EPS. Earnings per share, that's what it stands for. So, did we buy 10K? No, we did not. And I'm probably going to play for an extra 10 more minutes, or do an extra year. So in order to do this, we do $10,000, and we divide that by 26.89. So we're going to buy 371 shares of Yahoo. So right now, we own the equity and the debt of Yahoo, which is pretty great because the company is very, very cheap fundamentally. They don't have a lot of debt, and they're able to grow over time. So I want the common equity because I want to be a shareholder. I want to own a bit of the company. But at the same time, if I'm pessimistic about the economy in the future, we can own the bonds. So yeah, we bought some long duration. So we're just going to chill with that portfolio. We're going to play into I'm going to probably do into 2025. And then I'm going to probably quit for today's episode. So right now our portfolio is doing pretty well. It's and I was thinking about selling SBC, but at the same time we only made $3,000. Yep. So we're just gonna chill. So right now after tax, oh yay! So we look over here. The extra 20K is coming from the bond maturing. So right now, remember that low duration bond that we bought a few years back? Oh, where is it? Right here. So you can see this 2025 bond, General Electric. it's almost trading at par. So right now, if we want to play a cheeky little strat, we could actually make a little bit of money by buying this short duration bond, because right now it's below par. So our coupon is going to be too exceptional, but if we just do like 100 minus 93.87, 93.87 divided by 93.87. So we can make approximately 6.5% in a year if this bond gets matured by 2025. And if they have exceptional credit rating, they got AA, they got lots of variable debt, not a lot of debt to equity, great ROE, decent dividend. Yeah, we could buy this bond because it matures by 2025. And they have almost enough to cover the bonds, so they might have to issue a bit more variable debt. But it's actually a pretty low risk strat. So if I had a little bit of liquidity on me, I could make like a 6.6% return because the bond is trading below par. Below par is 100. So above par would be 100. So I found that pretty interesting. So we're just going to chill with that bond. Once we get our 20 grand though, we are going to be going into long duration again. So I tend to break the rules whenever it comes to my investing every now and again, because like I'm still kind of new to investing. Like I've been doing it for 5 years, but my strategy has been shifting every year. So we got about 40% in Bitcoin and equity, and we got about 57% in bonds. So right now we're over it by 18%. So we're like over 18% on fixed income right now. So we want to probably sell 18% of it once it does start falling. But right now the economy is hot. But you can see that right now oil prices are 153. So this is when I generally start to short oil whenever I play Wall Street Raider. But I usually do 30 or 50% maximum debt to equity whenever you do your oil companies and things. Because right now commodity prices are ridiculously high. But be careful. I've seen oil in this game go to like 200 a barrel, 300 a barrel. And I'm pretty sure it hasn't gone above 300. But still, $150 a barrel is quite high. That's like way above normal. And I would have made a bit of money if I shorted oil. But I don't do that in Speculator because it's much more riskier. See, look, there's a bit of a correction in the oil price. So with the crash in commodities, it's very, very likely that maybe the economy is not doing too well. Because if it does fall a lot, then it could just be a correction though, and GDP continues to stay strong. So we could have made like $25 a share. No, 25 a barrel or something like that. Okay, yield curve uninverted. So you can see like the short bond tanked and the long bond fell a little bit. So right now, yield curve is currently in upward sloping. So that means the economy is doing well right now. So interest rates might continue to rise. So it'll be good for, there you go, GE increased its EPS and its dividend. When do we get our bond back? 2025. Oh, it's trading closer to par now. So like if you buy 100 minus 95 divided by 95, we make about 5.2% if we just hold that bond into maturity. That being 2025. So generally in real life, I like to buy below par bonds, but because interest rates are very, very low, or like they were low, so I feel like you could probably buy some bonds that trade below par nowadays and make a little bit of the extra return. Yeah, okay, so now we want to go, now I'm glad that we went into bonds heavily, because you can see the short bond has fallen a lot, and the long bond's also fallen. So right now you can see that GDP is also tanking too. Commodity prices are still kind of high where they are right now, so it's going to probably put more pressure on the economy, and the interest rates are going to continue to fall, which is good for a portfolio. Like, look at our portfolio, it's mooning. So if we look at our bond portfolio, we move about $4,000 off of the Masco Corporation, and everything else, Yahoo, it's doing pretty well. So we're just going to hold those bonds for a long term. We are going to trim though. Whenever interest rates start to hit 4, below 4, I'm going to trim. If they hit like 5, I may consider trimming, or 6. That's for the long or the short. So right now might be a good time to trim out their bonds, but at the same time, I would prefer whenever interest rates go down to the normal rate, which is like 4 to 5%. And as long as whenever you're doing bonds, always consider that like there's gonna be volatility with that. So like the reason why you're buying bonds in real life are for income. You don't really speculate with them too much. Like in this game, I tend to speculate bonds a lot just because interest rates are usually higher than they are normally. But in real life, if you want to help reduce the risk of your bond, just buy it for the coupon. Do not buy it just because, I think interest rates are going to go down in the next few months. That's speculating in real life. Well, this game, it's a game. There's a lot less things that you can pay attention to or whatever to make. But like the theory is important. Look at abjects right here. I regret trimming out of abjects. See, look, sometimes you can be wrong. Like biotechnology, where is it? Right here. Abjects. Oh gosh, abjects is overvalued. Look at biotechnology. Like if you want to make a little bit of money on this, and if you own a biotechnology stocks, you could sell the stock, or you could do covered calls where you still want to own the share, but if you think the prices are going to fall, that will be a good strat. But we look at abjects, they don't have a lot of liquidity, and they're ranking up their bank loans. But like, look at the look at the net worth, and look at the current price. That's ridiculous. Lots of debt to equity, but they do have a great ROE. The only reason why I think this company is alive is because they have a great ROE. So if you look over here, typically whenever they have a great ROE in this game, it's usually because the management is very capable. And they're buying quality assets. So like if we actually look at like their if we look at their ROIC to the WACC, and for this example, what's their variable? It's 9.75. Okay, that's good to consider. So what we do, 801 divided by 996. No, not 966, my bad. That's about 82%. So 82% is in variable debt. So that will be 0.0975. Oh gosh, I'm going way above my limit. So that's about 8% borrowing cost. So 8%. And then their fixed rate debt is 7.6. So I'm just doing a weighted average. That's just what like I'm doing right now. A 155 divided by 966. That's about 16% at a coupon of 0.076. That's about 12%. Is that correct? Oh, it's 1.2. Oh, okay, that makes sense because it's a very, very little amount of their debt plus the 8%, right? Yep. So right now they have a borrowing cost of about 9.2%. So if we look into the abject stock, no, we look into the industry, we look at the projection, we look at abjects, they are currently returning lots of value to shareholders. So they have a 9.2% borrowing cost, so you just do 22 minus 9.6. So they're returning a lot of value to shareholders, even though they're a junk bond. So sometimes I could be wrong with my conclusion, but I think it's a much safer bet to get out of the company. Because right now the industry is hot. Like it's above the long-term average. So if you want to play Speculator or Wall Street Raider and you want to short, if you want to pick a short, I would probably pick this company, this company, this company, this company, this company. Like if you think their company is going to deteriorate or the industry is going to fall over the long term, it might be a good bet. So right now you can see that interest rates have fallen a lot, and if we look at our bond portfolio, we've done pretty well for bonds. Nice. So it's 2024, so we're gonna wait for our bond to mature. We still got our General Electric bond. It's trading almost near par, so probably doesn't make any sense right now to buy the bond. We do 99.14. No, we do 100. because all bonds mature at 100 or 1,000. It's weird that they quote in 100s. And so if we do times 100, you'll make about 0.86% return, or about 1% return if you hold it from September till 2025 when it matures. So it's not as much of a great opportunity, but like when it was 6%, it was pretty exceptional. And as you can see, our dynamic portfolio was doing really well because we locked in a lot to long bonds, especially the massive corporation. And right now the short bond is about 4%. So this is usually like the mid range in my opinion. Whenever it goes below 3 on the short bond. So right now it's about at the average. So if it falls below 3, then that's great. But I'm just gonna okay, here we go. We got a special event. Black Swan. Oh, boo. I should have trimmed that bond because right now we got a special event, a Black Swan event. Basically, a Black Swan event is something that people do not expect that can happen. So an example of that would be the COVID 2020 crash. People did not see it coming, and the market crashed aggressively and fast. Expressing concerns that monetary policy has been too loose in recent years, the U.S. Federal Reserve, monetary policy being the interest rates, so the cost of borrowing for consumers, and fiscal policy is the government budget. So you can actually look at tax rates. Whenever tax rates are high, that means that they're trying to slow down the economy. Whenever tax rates are low, they want to stimulate the economy. So right now the monetary policy has been too loose, aka at average. In recent years, Cuomo said that at the time, irrationally exuberant economy. Yeah, the economy has been really, really good. So it makes sense. The newly appointed Fed chairman in testimony, U.S. Congress, that's sudden tightening of money supply, raising rates, might plunge the U.S. world economy into a serious recession, saying that our data show the economy is strong and resilient at this point. And while a rise in interest will clearly cause some slowing in growth, there is no danger of plunging the economy into recession. So this is kind of what we're dealing with in real life. Like right now, inflation, I think in Canada is like 6.8%, and US is like 7%. And if you look at like countries like Russia, it's projected to be much higher than that. It's like, I think it's in like double digits. So right now we're experiencing a lot of inflation, and so I'm going to bet that interest rates are going to be going up. And so I regret not trimming. Yep, there you go. See, overnight, interest rates just boomed. And so let's see if we can take a quick profit. Oh, we can. Okay, so right now, before the game realizes that interest rates are high, we're going to go ahead and take some profits. That way we can roll it into more bonds. This seems like this video is going to be prioritized mostly on fixed income, I guess. So we made about 34 grand in profit. The current price is 1,170. 70. So right now we're going to sell about 29 bonds on Masco Corporation. So what we're going to do, sell bonds. Oh, we don't own any stock? Okay. What's the current price? Oh, I think it updated really quickly. Because right now it's at 60. Oh. That 1 second that I was playing the game, the game's like, oh, I realized that interest rates are much, much higher than they should be. And so now, if you look at like the price of the bond, it's at 117, and now it's at 67. So that quick change in price, so 117 minus, I think it's like, what is it right now? It's at 67. About a 74% drop, I believe, in the bond price. So that bond just tanked in value just because interest rates went up a lot. So that's unfortunate, but at least we're going to be getting the coupons, and plus we're going to be getting 20 grand soon. So we'll be able to roll that into more bonds or do more stock. Yahoo's doing all right. So let's go ahead. Wish I bought more Yahoo. 59% return on Yahoo. Not bad. Might be worth trimming. Yeah, they have a lot of debt to equity now, but they're still considered A. Are they growing? Yeah, they're growing a lot of their growth. So if them growing, they're gonna probably have a higher debt to equity. Once it gets above sorry, I have a really bad cold. Gosh dang children. They gave it to me. Cool. 24 times earnings. Currently a strong sell. Let's go ahead and trim out of Yahoo. But we did make like a $5,000 return, which ain't bad. It's also a very, very small position. They could, yeah. Don't trim Yahoo. It does seem like it's they are a very good growth company though, and like, yeah, it is above last year's profit in the 70 cents. So like, they are gonna do better. If I could sell calls, I would sell a call on it, but let's go ahead and keep it, and let's fill in Yahoo. What price did we buy Yahoo at? I just want to make sure. Yahoo. That's our new position. I'm gonna take a shot and keep Yahoo. So we paid 26.92. SBC, I think they did a stock split, so that's why the price is lower. So we paid 37.05. We don't have abjects anymore, so we're gonna get rid of that position. I think that is the Ethereum. Ethereum's cost basis is 2052 dot. And the Bitcoin one, I don't. Oh, I actually did the. Okay, my bad. I messed up the cost basis. 54.43. Oh, no, I did right. No, that's the Ethereum. Oh my gosh, I'm messing up so bad. And then the Ethereum, this is the Bitcoin, I believe. The Bitcoin is 52.22. And Yahoo's 26. So that way we can keep up with whether or not we're making a profit or not. They are aggressively growing though, Yahoo. So like if we look into like Yahoo, for example, and you look into the company profile information, and then you go into the cash flow projections. You can see right now they're making about $3 billion for their business operations, and they did make an extraordinary gain. So that could be that's like a one-time expense. That's like a one-time income. Planned capex is 2.6 billion. So right now with 3.5 billion, so after the tax, they're making 2.3 billion minus that. So they're gonna have a negative free cash flow of 2.3 billion. If we look at the current profile, they have about 3 billion in working capital. So after a year, they're gonna get that money because the inventory will be sold or they'll be paid back from the accounts receivable. They do have a lot of BABA, which is nice, but the BABA is something that is pretty high. So we can look into a diagram of holdings, and you want to go into this portfolio. Oh, we're on Alibaba. Cool. So like this is a subsidiary of Yahoo. They got 10 billion in working capital. They'll be able to pay off a bit of their debt. They have a lot of business assets. Not a lot of liquidity. Interest rates are high. 20% PE, 25% ROE. Very high amount of debt for Baba, and they're growing aggressively. But their ROE is exceptional. But they are actually they're losing, like they're not sharing any free cash flow. So part of me is actually feeling like trimming out Yahoo, just because the holding it holds is quite risky. While it's Yahoo is a bit of a safer play, but Yahoo might be a great play long term. It's just it could fall. Yeah. Well, I've been proven wrong before. Oh, there's a merger. Okay, so we have a new stock now. It's WLME, and they approved the merger. Okay. Wellington Merchandise has been liquidated into Yahoo. And we lost a bit on Yahoo. Oh, that's pretty interesting. Yeah, it's going down a lot. It's definitely a lot more reasonable in valuation, but they do have a high debt to equity, and they did lose their A grade. So now they're considered still investment grade, but if they do, I think if they go above maybe 0.5, like maybe if they hit like 0.6 or 0.7, it will likely be rated as a junk bond, and which will make them have a higher borrowing cost. And they're growing aggressively. They do have a good ROE though, a decent dividend. Pretty glad I had the bonds, but like, they do have a lot of unused bank loan, but they're they're investing a lot in their capital expenditures, which is might be a big. I keep doing that. I'm supposed to go to company info. Okay, negative 5.1 billion in free cash flow. So if we subtract that out, they'll have to borrow about 2 billion in the next quarter. Eesh. And it's very, very painful because interest rates are very, very high. It is almost 2020. Oh, yeah, and Yahoo crashed. Should have sold a call. If I sold a call, I could have made a good premium. But at the same time, it's better most of the time to sell the stock. And if you're also bearish on it, you can buy puts. And you can only lose the premium, I believe, on that. I'm not too strong with options, so I barely ever tend to use them. Okay, so right now, you can see that the economy has actually entered into a bit of a recession. Like the game said that the economy is strong and consumers are able to take this higher interest rate. No, they're not. Because if you look at right now, currently, if you look at industry, if you look at the, you look at industry and economic info, and you can look over here and see like interest rates. So like they don't give you much information about interest rates besides the short, long, and everything else. So right now, LIBOR rate, not very relevant. Consumer loans are 15%. So that being like credit cards and car loans and etc. And like lines of credit, I guess. Prime mortgage rate is 11. Subprimes are 14. So right now, rates are very, very, very high. So like 14% for your mortgage is high because like sometimes people are at 3%. And right now, I think right now mortgage rates are probably 6 or something. I'm not too familiar with that, but much higher than normal. And it's likely that interest rates are going to have to fall because right now the economy is about to go into a recession. Or it's in a recession because if you look over here, it's been falling a lot. But I think I have to wait for another quarter or at most 2 quarters until I get the data that they're actually in a recession. Yeah, Yahoo's estimates were slashed. $32. So we made a small profit on Yahoo. Should have trimmed. We made a 50% return. My rule in real life is whenever I make like a 50% return or whatever, I trim just because if there is a correction in the stock price, then I can buy at a lower price. If it goes up, I still make money, but I don't make as much. There we go. GE bonds are paid back in full. So now we're going to pause the game. You can see right now GDP is -5. So right now the government has to react very, very, very quickly to deal with this problem, and they're likely going to lower rates. So we're going to go ahead and buy a more long duration. 13%. It's pretty exceptional. So we're going to buy 20 billion. How many taxes do we have to pay? About about 2.7 grand. So I'll probably buy like 20 grand worth of bond. Okay, so we got 20 grand, $623 for the bond, 32 bonds, 20 billion. Yeah, I was wrong about abjects, but like I did see a bunch of red flags with abjects. So right now, let's just double check on how overweight we are with our asset allocation. So we're about 56%, so we're about 16% above our asset allocation for fixed income. been tempted to change my category from education to gaming because right now with YouTube, I have it as educational for most of my content. Some of it has gaming, and I feel like gaming is much more of a bigger market. So I might actually, I changed this one to gaming because this is a game, but there is some education behind it. Like, I saw a bit of red flags with Yahoo, but I did see a bunch of red flags with Abjects, but Abjects just continued to grow and make me bank. Okay, here we go. Major rally in stocks. Unhappy short sellers say government inverted. So right now they are inverted by like about 1%. So with the inversion of the yield curve, it's very, very likely, yeah, the economy is not doing well right now. So I'm pretty glad that we moved most of our money to fixed income. But you can see right now that the Bitcoin, Ethereum has a decent amount of return. So let's just check. Like, I feel like the typical range for stocks is 50% up or 50% down. So almost all the time, I believe it makes sense. That's just my personal opinion, though. I believe that trimming every now and again is a good strat. If you're still bullish on the company, just sell covered calls or do puts until it gets to a bit more of a healthier valuation, in my opinion. So we made about 67% return on the Bitcoin Trust. So like that's gonna provide us with like a decent capital gain. So like we go over here, sell Ethereum. It is a strong buy, so like it might be worth keeping. They do have a lot in Ethereum. It is a thematic ETF, and it has a very high borrowing cost, but they do not have any debt. Trimming would have worked on Yahoo. Sorry, I messed up on your strategy. Yeah, no worries. I'm long term. Yahoo's still a pretty great company. It's just the only problem is interest rates are high for them, and they're growing like aggressively. So eventually, it's gonna hurt their capital. Like, you just want to be very, very cautious about debt in this game, because like if a company has a lot of debt, it basically means that you could lose a lot. They're expected to. Yeah, let's go ahead and trim out of it. Even though it says strong buy, sometimes you want to be, like in my opinion, sometimes you want to be a bit, you want to be a bit of a contrarian when you value invest in. Like right now, the market is hot for Ethereum. Everyone wants to buy Ethereum, so I'm getting out. Or at least getting out a little bit. 77 shares we're going to trim. So we're going to keep about 120, I believe. So that's about 7 grand we're going to get. Capital gain of 2.8 grand. That's not too much, but that's a decent amount. We are very, very overweight on bonds. I've been breaking my asset allocation the entire game. But eventually, whenever rates do go back to normal levels, like 4 or 5, we are going to go back to our regular asset allocation. Nope, did not want to do that. How much taxes do we have to pay? I'd say about 4.5k. So we'll probably buy 10k of stock. Should I do 10k of stock or 10k of bonds? Bonds right now aren't a bad option. Here, let's take a bit of a gamble. Let's do some convertibles. So we're gonna do 0% premium because I'm looking for a below par. That way you get a bigger coupon. And we're looking for companies with quality earnings growth. Yeah. I think this is a biotech company. 6% coupon. Yield to maturity is 0 because it's got such a high price. So that's probably not a great buy. Canadian Pacific Railroad. 14% coupon. Damn, that's a good yield. Enough liquidity to roll into a new bond, and they could also do bond cancellation. It's got a decent duration, so it's not too long. It's about double the book value, $2 earned, 8 times earnings. That's very, very cheap. Quite a lot of debt though. That's my only red flag. But they do have a great ROE, so they're very, very good on giving return to shareholders. $1.80 dividend doesn't matter because we're going to be buying the bond. The stock wouldn't be a bad idea either, but the convertible bond I think is nice just because it offers a coupon payment. So like for example, we can see right here, the yield is 3.21. So right now we can look into the bond research. Yeah, so they're gonna do a lot better than last year. And they're triple B. They're very capable. Interesting. You know, 955 million. Pre-tax operating margin is 27%, and they grew at 15%. And if we look at the coupon, it's so like their WACC, I believe, is sustainable. So if we can see if the convertible bond yields more than 3.21, I think I would do that. By CP convertible bond, what's the yield? Current yield is 10. So like that's why I always like to do convertible bonds in this game every now and again, because if I like the stock, and I also am a little bit pessimistic about their future earnings, I feel like it's a good strat to go into a bit of the convertible bonds. But the problem with this is this bond will move with the price of the stock, so I'm still bullish on the company. I want to look at the price. So we're gonna buy about 10 billion of this. I definitely want to bring up this position a lot more because they're a quality company. 611. So about 16 of them. 10 grand, not bad. Accrued interest of 200. That's basically me buying the bond from someone else and then saying, "Oh hey, you held this bond. You held this bond for 2 months. I owe you this much interest." Not sure if you get back or not. Okay. So I'm probably gonna call the stream over in a bit. 64% in bonds. So right now we're 24% overweight, which is very, very high. So I'm gonna stop buying bonds from now on and start doing more stock. And Bitcoin, of course. Okay, 32%. So right now we should have about 60% in equities and speculation. Right now we have about 38, and we have about 64% in fixed income and a little bit of cash just for tax. 11 grand in corporate bond interest. We made a little bit in dividend. The thing I like about corporate bonds, they're a debt obligation, so they give you it. So corporate bonds, they pay out interest. So that means that basically, if the company cannot pay that, then basically they break the debt obligation, they go bankrupt. Yeah, thanks, dude. And then dividends come out of profit. This comes out of, like, it's EBIT or whatever. Earnings before interest and tax. So then after that will be interest, and then after that comes taxes. So the great thing about corporate bonds in the game, and when you're playing Wall Street Raider too, is you actually have to consider the tax cost of debt. So like for example, you can't just be like, oh, I have a 7% bond or whatever and I'm paying 7%. No, I do, like, let's just say where's the tax rate? Tax. Corporate income, capital gains. So let's just say, okay, so I think we do 7.00% minus 0.21. It should give you a higher, should give you like, right. I think it's that. I have to Google something. Take the take the average yield to maturity, multiply it, and then multiply by 1 in tax rate. Okay, I see what they mean. Okay, so you do 1 minus 0.21. 1 minus 0.21, 0.79. So we just do 7%. So we do 0.07 divided by, let's do 7 divided by 0.79. Pretty sure that's right. So like right now, if they were to buy a bond or something, it'd be about but the after-tax cost of the debt will be 8.86. I'm pretty sure that's right. It should be. I'm not sure if it should be lower or not. It's like your after-tax cost of debt, because whenever you have like a bond or whatever, one thing I found is very interesting is that you can deduct out the interest. And they're a cool asset class and that I want in this game, but I don't think I emailed the creator. I'm like, hey, you should introduce preferred shares because they're interesting because they usually give out a bigger yield than the common and the bond, but usually it's not a preferred way to raise capital because it's like in between debt and equity. Okay, how are we doing? Ethereum's doing alright. Bitcoin's not doing too well. So Bitcoin might be a good buy. I want interest rates to return to normal. So I'm probably going to play into 2026 and then I'm going to probably call it for the stream. Because if I do 3-hour streams, people are not going to enjoy that in my opinion. That's not some good content. I'm trying to make my streams a little bit shorter. Report profits. So they did make a profit on hedge in the oil position. Right now, our convertible bond has made us a decent amount. If it trades closer to par, I'll appreciate that. But we're making about a 10% yield before tax. So right now, if we see economics, ordinary income, that's like dividends and interest. Okay, so like let's just say we make like a 10% coupon. 0.74, and we do so right now our current coupon is about 10% minus 0.74. No, not divide by 10 minus 0.74, 9.26. So right now our after-tax yield I believe would be 9.6. So that's not a bad yield for bonds, and if it's like 13%, that's pretty good. So right now our after-tax yield is pretty exceptional. And right now the economy is just in a deep recession. And right now you can see that interest rates are starting to slow down. It's like there's been a bit of a dip. And so that has me pretty confident that our bond portfolio is going to do well this year. Because if the GDP continues, yeah, oil's falling, so that means that it's deflationary. So more and more deflations happen. So they're going to have to control the monetary policy because everything's just basically fallen. Slash earnings estimate for CP Rail. Still making a decent amount. Oh, another thing that I forgot to include was CP Rail bonds. Basically, you get 7.78 shares per $1,000 invested. The current share price is $60. So right now, in order to make a profit, aka a big capital gain on this bond, the bond has to trade at 128 a share. But like, I think the business is a very quality business because I looked into it a little bit and I'm like, hey, besides the liquidity, they don't have a lot of cash on hand. But they are growing at like crazy levels. My only concern is company info, physical commodities. They own some oil at like 93, and if it shows like a negative in there, I believe it's a short. So this is the only thing I'm really skeptical about. Is the whole fact that like they bought a bunch of oil. Like they have about $5 billion or whatever in oil contracts. Are these futures or? I'm pretty sure they're physical. Yeah, they're physical commodities. Yeah. So that's my only concern is about $5 billion is tied up in commodities, I believe. They've lost about $200 million in hedging their oil. So the stock is likely going to underperform because oil prices are falling. So like if you look at CP right now, look at their physical commodities. They lost about 500. Yeah. And okay, so like these are futures because they have a settle-in date. That's pretty cool. Okay, let's just hope that the interest rates fall, and then I'm gonna probably call it quits at 2026, and then continue next episode. I wonder what price we got the convertible bond for. We definitely got it for a little bit lower than what it currently is. Oh, there we go. CP Rail's doing well. The convertible is starting to trade closer to the par, which is nice. Still a bit off par, though. Does give a good yield of 10%, though. And we have exposure to their common shares. And it has a much higher dividend yield. No, it has a much higher yield than the dividend, because the dividend was like 3%. The only problem is, yeah, right now dividend yield is 0.76. Yeah. So the dividend yield could have grown or it could have shrunk. They do have a lot of debt. They're considered junk right now. Are they growing aggressively? They better not be. Yeah, they're growing aggressively. Damn. So that's good for them, but cost of capital is going down. That's why my stocks are doing really well. If capital is cheap to borrow, then it makes stocks really well to do. So right now the bond portfolio is doing pretty well, especially the convertible that we bought. Like it's trading almost at par, which is pretty great. I wish I bought more CP Rail. I'm probably gonna keep that until it matures. Maybe trim once it hits 128, if it hits 128. Now you can see my chart. I've actually been doing pretty well. Like our long duration bond portfolio is starting to do pretty well, while as our stocks are doing all right. September, October, November, December. Then we're going to call it quits. Yahoo ain't doing too well. I should add CP Rail to there. So I think the conversion price was 128. I think this is a approximate valuation for the bond. Yeah, I think I bought CP Rail at like I think I bought it at like, let's just say 60 to 80. I bought it at, I think. But it's starting to trade closer to the par, which is nice. Okay, so right now is when I consider dumping all my bonds, or at least dumping a massive majority of them. Because right now rates are very, 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 very low. So right here, 25 grand. We're going to definitely take that. Okay, let's just do a quick rebalancing, and I'm going to call it quits. So right here, 232, 994 times 0.60. So that's our crypto and our equity. So our target is 139,796.40 subtracted by the current valuation of our stock and etc. Stock and bitcoins. 139,796.40 subtracted by 55,025. So we need about 84 grand. 84,537.40. So that's the amount that we need in equity and speculative. If you want to get like the Bitcoin, can you see that? Yeah, you can. Oh my God, it's kind of hard to read. There we go. That's our target for both. Oh, it's actually 200,000. Is that right? Oh, I got that. Okay, I see what I mean. So it's like, so we need 46 grand and 46K subtracted by our current portfolio for crypto. Crypto is currently at value of shares owned, unrealized gain loss. Pretty sure it's 12,168 plus 7,109. That's about 20 grand in Bitcoin and Ethereum. If we look at it compared to our, if we look at that, so like we got that. So like that's our total value of our Bitcoin and Ethereum. So we're at about 8%. So we have about 20 grand. So I'm just going to subtract it by 20 grand. Oh, I'm so bad at math sometimes. Okay, so we need about 26 grand. Let's just say 20. Okay, so stocks, we would like to have ideally, our target is 40. So sorry about this. This is kind of tedious, but this is like what real life is kind of like. You got to do a bit of portfolio management every now and again. So right now we're just trying to get back to our balance. So we need 94K in stock. Then we subtract it by the total stocks that we own. So right now we had about 20K, so we could just cheat the math a little bit. So right now we have about 59K. So we just do 59,221 subtracted by about 20K in Bitcoin and Ethereum. Okay, so this is where we have to get to. Okay, so we need to sell about 50K worth of bonds without affecting the price much. So we did 26,500 plus 39. So we want to trim out 65K of bonds in order to get back to target. And we're not going to give a damn about cap. Wheat prices collapsed, so that should ideally make it more deflationary, which will make interest rates even lower, hopefully. If they go up, I swear I'm going to be pretty mad. If you guys can read that, that's good. Oh, okay, that's cool. Spot prices of wheat have fell about $3. Damn, that's quite a big deep. Okay, let's go ahead and rebalance our portfolio and then call it quits. So right now, okay, so we need to sell. So this is trade at par, so I'm gonna go ahead. How much profit did we make? We made about 24K, not bad. $24,000 time divided by 1,024. So we're selling about 23 bonds, 23 or 60. That'll give us about 23K. And how much capital gain did we make? 23K. $50 commission. Net sales of 23,400. You have capital gain of 8 grand. Not bad. Not bad, not bad. Okay. So now we got about 32K. And I want to probably get out of Swire because we made a decent amount off that. Yeah, this is way above par. Generally, sometimes it actually makes sense to buy above par, especially if the coupon or the yield is exceptional. So like $6, you're gonna make about a year, and you're paying $19 over par. So you make $6, 12, 18. So after 3 years of coupon payments, you're gonna break even on the bond, and then you're gonna get $100 back after a period of time. Minus 119,6. So we're gonna sell about 15 of Maslow something. So we're gonna sell about 15. That will give us about 15K. We make a capital gain of 5 grand. Not bad. Where are we at now? 47K. So we need an extra like 20 something K, I believe. 65, 700 minus. It doesn't really matter if we're off by like a little bit, but if you're off by like plus 10 or plus 5, I think that's a big deal. Especially plus 10. Minus 47, 632. Like, of course, like, we're gonna have a lower number just because we have to pay tax. So that'll be 18 grand. Oh gosh, this is the longest episode I've ever had in a while. So we just sell 15 grand of bonds and we're done. So we can sell more Swire, but I'm probably it does take up a good amount of our portfolio. Or 230,000. Yeah, about 16. I'm gonna sell more Swire. I'm just gonna sell let's just sell 17K. Because it's way above par. I would prefer to get those gains. So let's sell another 15 of the bond, and then we're gonna be good for our asset allocation. 15. If you want to play it risky, you could theoretically just sell all your bonds right now, and then keep cash or do bond laddering. So bond laddering is basically where you buy, like for example, what's the current year? It's 2025. That's also good to know. So it's 2025. So bond ladder will be buying a 2026 bond, a 2027 bond, 2028 bond. I did that in the I did it in bonds only challenge, but that's how you reduce your interest rate risk because you're spreading around. Okay, where are we at right now? Oh, no, not times. We're divide. Okay, so we got about 13% in cash. Got about 13% in cash currently. 64K divided by 26% is 26.92% in that is in equity. Rebalancing portfolios are a little bit tricky, but I don't need to divide by. Oh, I'm just gonna reset. And then you divide that by 239.3. 59% is in bonds. So we still need to sell a good portion. What the actual heck? Oh my gosh. What else do we have to sell for bonds then? So we definitely want to get to 40% bonds. So we do 142,885 times what? 57K. Right? No, that's wrong. My bad. 239,492 times 0.40. You need about 95K in bonds. Bro, I just sold a ton of bonds. What the actual heck? What was that number? It was like 67K. Oh, I'm so bad at math. 95K. Okay. So we need about 47K more bonds sold, and then we're good. Sell more Masso, I guess. You know, I just dumped that entire position of Masso bonds because like they're a cyclical. Let's just dump it. So that's about 42K. We made about 9 grand off that. Not bad. Okay, are we back? Are we somewhat on target now? 99,736 divided by 239,283. 41% is in bonds, so we're good. 64,449. Oh wait, no. 23. Okay, so I'm just gonna double that amount. So we're gonna go ahead and next episode we're gonna go ahead and pick our securities for next episode. So today we're gonna make it off. We are all rebalanced, so we're all good with that stuff. Cool. So tomorrow I'm gonna, oh no, another day, I'm gonna go ahead and update this portfolio. Right now we have a good amount. We've basically doubled our money over the last 5 years. So we're doing pretty well with our bond and stock portfolio. Our Bitcoin's doing pretty well too. We still do have bonds, which is nice. So we're making about 6K in coupons. So we're doing pretty well right now. So I'm going to go ahead and end the episode here. Next episode, we're going to use our cash and we're going to invest in some quality companies that are able to grow. And we're ideally going to do stocks because interest rates are very low right now. So if we can find a company that's able to grow a lot, we're going to be able to make bank off that. Anyways, that's it for today's episode. We did pretty well. Like, here's our current progress so far. We did pretty well with the bond allocation. And if you do, I think, MISC, and then you do, stock price, you can do train status. Here we go. So now I can do margin. I can borrow money to invest, which is kind of dumb. Your net worth has increased over the last 7 consecutive months and has grown 79% during that period. Right now, the player who has achieved the highest number of net worth in the game is Donald Trump, in short. Yeah, someone that has invested a lot of money in tech has done better than me. Damn, SBC is doing well, I guess. Yeah, so we got about 10K in tax liability. Oh, about 10K. Interesting. Well, that's it for today's episode. Thank you guys for watching. I'll talk to you guys later.